Welcome to Market Matters. Today is March 2nd, 2 o'clock, and I look forward to sharing some time with you today. Just some housekeeping items. As we have in the past, we do put everyone on, request everyone stay on mute, and also cameras off just so there's no real distractions along the presentation. If you do have any questions, please feel free to send those along via the chat feature of Zoom. I certainly will not be sending any links through the Zoom chat feature, so don't click on anything that looks suspicious as a Zoom link or a link through the Zoom chat feature. I'll try to grab those comments or questions along the way and address them when I can, but certainly if possible, I'll address them at the very end. So with that, let's get started. In our typical fashion, we'll cover a few areas, and the main areas are, an update on where we sit with the COVID virus. I do think that still influences a lot of what we're going to be looking at from an investment perspective, as well as future positioning. We'll go through a brief economic and investment update to include some portfolio positioning. And I do think this topic has become more important to touch on. And certainly it's one that I know that you all have been asking to advisors or in your quarterly meetings. So I thought it was important to address, when do bond yields become problematic for the stock market? So I look forward to sharing some information about that. So let's get started. Turning to COVID, I think as you all probably are aware, there's a lot of good news relating to COVID. You can see here what you see in the chart is the average daily vaccine rates that are being given. You can see a noticeable uptick beginning probably mid-February to first it was that 1.5 million mark. Now we're up to above the 2 million per day. And this is as of February 28th. Average, the weekly average is still in the 1.7 million doses per day range. But I think what's important, or what's really nice, is that this is the current run rate as of the last few weeks is getting us above that 2 million doses a day, which you'll recall Joe Biden and his administration has indicated would get us to a herd immunity, or not full, but like an 80% vaccination by potentially late summer, which would be a little bit ahead of schedule based on, I think, last year's projection, which was maybe closer to the late fall. So that's definitely a positive, and one reason why I think markets are responding positively as well too. The global picture, however, is a little bit more nuanced. Certainly developed market, and this is something, of course, to keep in mind as we invest not only in the US, but also internationally. And most of the companies on the equity side we're investing in have international revenue streams. So it's important to keep an eye on what's going on internationally. And I think that the picture is a bit more mixed, potentially even negative, outside of most developed markets. And then, of course, somehow Chile and Morocco are in there on the plus side. What you're seeing here is number of doses per 100 people. And you can see, dark green means more people are being vaccinated as a percent of the population versus 0 to 2 in the lighter areas. Africa really doesn't have much by way of data to suggest, but I think what, as the Bloomberg vaccine tracker would suggest as of yesterday, at the current run rate of vaccinations, whereas in the US and in Israel, of all places, herd immunity can be achieved this year in 2021. Unfortunately, at the current rates of vaccination and development and distribution, it looks like globally, the world won't have herd immunity to this until what they're estimating somewhere in the neighborhood of 4.5 years from now. That's one reason why I think this COVID situation is not something that's just going to go away, because it's going to be something that's going to be with us for quite some time. It's going to have a variety of different impacts in various parts of the world. But developed markets appear to be leading the pack here, as you might expect, with developing markets or emerging markets a little bit behind. So we'll have to track progress there to see if we can ever put this behind us at some point. But medicine is advancing rapidly, so maybe there is an option for that to occur much quicker. So this is a great chart from Bank of America and the University of Washington. And it just shows how effective the vaccine has been at really stamping out two things. The first thing is infection rates are showing how a rapid decline in infection rates is occurring at the same time we're starting to get some of the vaccine. you can see it's just been an improving picture 1 week after the next. So you can see here the number of daily infections has gone down from a peak last in December, roughly about 360,000 folks per day, down all the way to where we are now, which is as of February 20th, right around 40,000 people per day, which is a massive improvement. And really, I think one thing that a lot of folks are looking at as to say, well, maybe the economy will be reopening sooner than we expect. Hospitalizations, I mean, this is also a really important metric, particularly for the older part of the population. You can see very similar situation whereas, a few weeks ago, we had about 130,000 people being admitted to the hospital every day. That's now gone below 20,000. So approaching that early part of the infection situation back in March of last year, which is just a great situation. And again, the reason I still look at this stuff is because, well, number one, it's very impactful to a lot of our lives, no question, but also it also helps give us an idea of potentially when reopening can occur, which is of course going to be the big catalyst, I think, for the U.S. economy in particular later this year. So now that we've looked at the COVID update, I think it's a good news story all around. Let's take a look at some of the economic and investment updates. So this is just a view of our current investment ratings. You can see there have been some changes over the last couple of Market Matters. At the last Market Matters, we had indicated we were decreasing our exposure to bonds of all categories. So what was previously more of a neutral stance, we've moved to a little bit more of an underweight stance. But two upgrades that we've had recently would be one, which we'll talk about in various detail. One would be upgrading mid-cap companies to a more neutral stance from a less attractive stance, really on the back of a quicker reopening. And number two is upgrading liquid alternatives, because they will be likely the source or destination for a lot of the capital. We'll be moving out of bonds into things like liquid alternatives, which would provide us more diversification potentially and return potential than bonds will. Generally speaking, this is some of the notes that I just referenced, but here are some of the portfolio notes that I thought were important to touch on. One was that we did have a modest rebalance, not a full rebalance. We were able to get off a modest rebalance in late February. That's primarily because the market, kept moving higher and up and in through the end of the year. We're able to trim back some of those growth-oriented equity positions in favor of not only value-oriented equity positions, but also adding to our alternatives and cash holdings. So we're really pleased with that. And we're also just wanted to note, we are raising levels of cash across the accounts, very similar to what we did back in 2019 and even in 2018. Not that there's any real, risk on the horizon of a market collapse or decline, but because it's just part of our process that, as markets climb, particularly on the equity side, we're raising cash to seek out opportunities on a rainy day. On the equity side, it is worth noting that there has been a sharp rotation in equity leadership that's confirming strength that is likely to come about later in 2021. We're already starting to see some of that data on the upside, and that's starting to come through on the economic side for sure. But the rotation in equity leadership is starting to occur. We'll show you where that's cropping up. Active strategies are performing well in this environment as well too. We called that out last year as I think a perfect environment, or not perfect, but a really positive environment for active strategies that are discerning about where they're putting capital. And I think that's some of the performance we've seen so far this year is just an emblematic of that dynamic. And as I mentioned, we're evaluating some potential mid-cap opportunities. Looking at fixed income, the bond portfolio, the role has definitely changed. I think that we mentioned or have been calling that out for a couple of these Market Matters episodes, but I did want to reinforce the idea that bonds, by starting at low yields, are presenting a less attractive risk and reward. But there will be opportunities in bonds, because I think low volatility in the bond market begets higher volatility at some point in the future. We just have to be ready to capitalize on it. And that's precisely what the cash position is meant to do. Not too dissimilar to March of last year, where you had for a time there, you had investment grade bonds, the LQD index was yielding something like 8% for a few days before the Fed stepped in. It's those types of opportunities that we'll be looking at. Interest rate volatility is rising for the first time in a long time, meaning bonds are getting more volatile. You started to see that over the last few weeks. And this is important to keep an eye on, because if it's just bond volatility, up and down moves, that's one thing. But if it's movement straight up, like maybe we've seen in the last couple of weeks, then that's a bit more problematic. So, really it's the pace of the move that is really important, not necessarily the level. And I'll talk a little bit about that in the special topic. And I see the note here. Can you please define the term equity leadership? Yes, I will certainly get to that when we get to the equity section. Thanks for the comment. And then on the alternative side, we are adding liquid alternative strategies at the expense of fixed income. This is primarily because the starting rates of return for liquid alternative strategies are far greater than they are on high quality bonds right now, particularly as bond yields rise. That means that bond prices sell off, and we just don't want to get caught in that, scissor effect, if you will. So let's take a look at just some of why we think, the market this year, or the S&P, is setting up for a fairly positive outcome. Number one is that governments, not just in the US, but globally, are supporting in a number of different levels. And this chart, I think, says that in spades. So what you have here is central bank actions, meaning the Fed, the European Central Bank, and others. And that's, they're providing liquidity to the markets. In the case of the United States here, for example, the Fed has provided something like 6.2 trillion to the market, which equates to roughly 30% of our economy alone this year. The other aspect you have to consider is the fiscal side of the house, meaning what kind of support is Congress providing to its citizens. I think everyone in the U.S. has seen, stimulus check payments come through of some varying degree, and then another one's on the way. It'll be the third so far. That's estimated to be somewhere around 4.1 trillion, roughly 20% of the economy. And then you add these two items up, and what you get is, globally, while the US and Eurozone and Japan have been kind of the leaders in providing liquidity and stimulus of various types to the market, it adds up to about 30% of the global economy in the form of payments or support for the markets has been provided. It's a very strong force to overcome, I think. Certainly there's going to be liquidity crunches, or there's going to be volatility in the markets. There's no question about that. But this is a very powerful force to try to overcome. And this is one reason why I think markets will probably have a buy the dip mentality for potentially the first part of this year, until we get into maybe a more challenging rate environment. But this is unprecedented, and I think it's important to recognize that. And it's long story short, these conditions are very supportive for stocks. However, there is a downside to all this. I know in previous market matters, people have asked about the debt being a problem. This is an estimate from the Congressional Budget Office from September of last year, indicating what our outlays in blue versus revenue in, and that distance or gap would look like. It's going to mean that we're going to have budget deficits that are growing over time, potentially, assuming there's no big change in the tax regime or other. And this is going to be potentially come at a cost of inflation at some point in the near future. Now, there are plenty that would say that, there are theories that suggest that in a aging society, inflation is much harder to get than it is with a younger society. But that remains to be seen. And that's one of the key risks we'll be looking out for, is that inflationary risk. Where's it going to come from? It's going to come from this type of dynamic right here. So we'll be on the lookout for that for sure. Going back to some of the economic conditions, this is a similar chart, almost identical to the one I showed last month. But wouldn't you know that home prices are now, just above 10% on a year-over-year basis, and that has everything to do with two things. One is the movement around the economy of people that are able to now work from different locations, creating demand. But on the supply side, more importantly, I believe I saw a note from the Case-Shiller home price providers that says that we're at only 2 months of supply of housing. That's the lowest on record, going back to, I think, the 1960s. And it's likely only going to get worse because there's a lag effect between new home construction and delivery to the market. So as it turns out, that's actually one of the areas or sectors of the economy that we like a lot right now, whether it be on the private side, providing financing to home developers, or in other parts on the bond market where you've got mortgage-backed securities. So the housing market remains a very positive light that we think is an investable theme for sure for the foreseeable future. Let's move on here just a second. And I just wanted to point out as well too that after a pretty nasty contraction in the manufacturing sector, we got yesterday the numbers from February on the manufacturing sector, and what you can see here is that we're approaching near all-time high levels in manufacturing because there was a halting effect, a year ago last year, that translated into some pent-up demand that started to make its way out, and now it's starting to rise. I wouldn't be surprised if we're at all-time highs here in manufacturing, or not all-time, but maybe 30-year highs in manufacturing sometime over the next few months as the economy really starts to kick into gear. Because inventories are down across the board, and now we're into a restocking process. This is also one reason why we think that the U.S. economy could surprise to the upside. The average, I think, economist is expecting the economy to grow, 4 to 6%. I think that could be low, and that maybe we're in the 6 to 9% range when all's said and done for 2021. So this is to address the question about leadership. Thanks for the question, Stuart. So equity leadership. So what parts of the equity market are doing better than others, I guess, is another term for leadership. This is a year-to-date picture of the same sectors that we keep an eye on, just small cap stocks in green, emerging market stocks in blue, the S&P 500 in black, and international developed stocks, or the IFA index, in red. And what you can see is developed markets still, large cap developed market stocks are coalescing around the same return. This was as of, I believe it was, let's see the date here, February 20, so last Friday. And, coalescing around that just below 2%. But look at what's happened with small cap companies, which are, by the way, much more sensitive to changes in economic growth than large cap are, for a variety of reasons. Are leading the pack here so far year to date with a plus 11, which is a pretty remarkable return for that segment. But it's also important to keep in mind that's a much smaller part of the market, a lot less liquidity there, and small changes in demand can really push those prices up. We're not necessarily too attracted to small cap. I think mid cap, which kind of sits in between the S&P and the small cap index, it looks to me or us as a potentially better option. And the return for mid cap is somewhere in between here so far year to date. Emerging markets continue to punch above their weight right now. They also tend to be commodity driven as well as economically sensitive. So as you all are aware, we've added to our emerging market position over the last 6 months, and we'll probably look to do so again at some point in the future. So turning to fixed income here real quick. I think it's just an executing on our game plan that we laid out 6 months ago, where we were expecting lower rates now, which was 6 months ago, higher rates later. We've started to see the first move higher in interest rates, which we'll touch on a little bit again in that special topic. But you can see what's going on here. The economically sensitive parts of the bond market, junk bond market, is doing much better than the high quality bond market, government bond market, corporate bonds. We're so far year to date through the end of February. High quality US bonds are down about 2.25% in price. And that's primarily because rates have risen pretty decently over the last 3 to 6 months, going from 60 basis points in the 10-year back in September now to about where we are today, which is about 1.4%, which is a big move. I mean, it's more than double the yield, and that's creating some price pressure. As you all are aware, we still have no interest in international bonds or emerging market bonds. It's just rates are too low in the case of the red line, and emerging markets are not necessarily great creditors in the blue line. At least they're just not cheap enough yet to get interesting. So we're executing on our plan, which is staying shorter duration, higher in quality, but also converting some of our fixed income exposure into other areas like liquid alternatives, which I'll touch on more here in just a second. I've heard a lot recently about the commodities and the next potential commodity super cycle being, uh, people like to equate things in kind of round numbers. Apparently, we're due for a 12-year upward move in commodities. I don't know about 12 years, but it certainly does appear that commodities are starting to price in higher growth in the future, or at least over the near term, probably 6 to 9 months. Commodities really aren't as much of a discounting mechanism as stocks are to that degree. But you can see from everything from base metals, which is your copper, your tin, iron ore, to agricultural products, which is the grains, corn, wheat, soybeans, things of that nature. Energy prices here in blue have all rallied pretty dramatically. And livestock is, I guess, lagging for one reason or another. I have no idea why that is. But I guess what I wanted to point out here is that commodities too are signaling that some inflation is upon us or likely to hit the economy. And how, if this is going to be a more temporary situation with inflation or not is to be seen. But I think commodity prices rising would tell you that we have higher prices in our future for a lot of the end items that we all like to consume on a regular basis. So commodities are actually, signaling that some inflation's on the horizon, growth of a higher degree is on the horizon, and we're certainly positioning our strategies to account for some of this. Volatility, I did want to point out, I mentioned this in the last quarterly outlook, which was in early January, but we are looking for ways to capitalize on this new higher level of volatility the market seems to find itself in. This is the Vix Index, and just for reference, the Vix is a measure of option activity on the S&P index, and you can see what was once a very tranquil volatility index down here lower in 15 is now gone into this new higher range of 25. And the reason I think this is important is because it indicates there's a lot of fear in the equity markets right now, which is good because that means there's still some skeptics out there to allow prices to go higher ultimately. But also, if you're investing or looking for ways to capitalize on this fear, one way to do that is through strategies that utilize options, where you're an option seller, or in the case of being an option buyer, where you're trying to capture those big up moves in volatility. So we are actively looking at ways to capitalize on this, because I do think that volatility is going to be with us for quite some time. Interest rates are likely going to create some of those opportunities in the equity market for sure, but we definitely want to be ready to capitalize on those when the time comes. So let's go on to the next slide here. I do see a question here, one about trailhead investors. Yes, we do have a separate performance rundown for our private strategies on a separate webinar, which will be coming up here, I believe, at the end of April. So hopefully that answers that question. We'll get you more information on that when the time comes. Thanks for asking. So just some key takeaways here would be, equity markets, they are set to generate lower positive returns over the next 10 years. That is going to have quite a bit of volatility, I think, here and there. And that's certainly what the VIX is telling you, but also I think what performance within the sectors is telling you. And the key is we need to remain flexible. Just like last year, you need to be ready to act on opportunities when they come up, because they're likely to be very fleeting. So being an active manager in this environment, I think, is really one of the only ways to have pretty good longer term returns in equities above this lower kind of index rate. And we've outlined this. I would encourage you all, I know there's been some issues on the website around formatting, but I would encourage you, if you can get it to pop up, that the capital market assumptions publication we just published on the website actually speaks to some of this, some of these return assumptions we're making, so I think your advisor would be happy to walk through with you. Bond positioning, I think our changes there have been well timed. We certainly are outperforming the bond index this year, as we have over the last, call it 4 consecutive quarters in a row. I'm sorry, 3 consecutive quarters. And we're updating our bond weightings across accounts to reflect a higher risk profile. So what does that mean? Again, reducing the allocation to bonds, looking for where areas to deploy that capital, which would be either in equities. We certainly have a recommendation out from the investment committee to upgrade equity exposures where appropriate, or to things like either private markets or liquid alternative investments. And then, small cap stocks, emerging market value, commodities, these are all confirming some reflationary sentiments that are being talked about in the economy and the financial markets right now. We're certainly looking at areas where we can capitalize on this in really more of a risk managed way. And I think we're kind of coalescing around mid cap as being a potential add to the equity side, but we'll see where that all ends out because there's a lot of work to do around that. Let me just see if I can address some questions here real quick. So looking at the different, like what is a liquid alternative position? So we do have a definition of what a liquid alternative is before I move on here to the special topic. The definition of a liquid alternative is a strategy that has a low correlation to both the stock market and the bond market. Because again, it's our belief that in the next phase of this market cycle, the bond market is likely to cause problems in the stock market. We don't know when exactly, but at some level that will be. And in which case we want to make sure we have positions in there that can do well, or at least generate some sort of positive return or return that's different from the stock or the bond market. And it takes a lot of effort and time to figure out what those would be. So, areas that you might find in the portfolio right now would be things like macro strategies, which are basically go anywhere strategies that can invest in currencies, different types of bond markets that can go both long and short. That's one. Other areas like insurance-linked strategies. We've been a fan of catastrophic bond insurance strategies or reinsurance strategies that have been very successful in navigating some of the problems, particularly in last February, March. Those insurance-linked strategies had no impact from what was going on with the COVID, which was really nice to see. But it takes a lot of time, and there's also more unique types of fixed income strategies that can go long and short that are meant to generate a return. And then the other question I had here from Stuart which was, please explain how the U.S. are able to pay for this incredible debt and danger to investors. Well, it's a great question, Stuart. I actually outlined it here in this slide right here. So that segues nicely into, at what rate or what point do interest rates become problematic? Before we get into that, it's important to understand, ways that government manage debt. So, at some point, as Stuart points out, interest rates become problematic either because they're unaffordable, like in the case of Argentina. Argentina has had to default on their debt probably, I think it's like 10 times in the last 100 years. That's one way to deal with debt. The other way is you raise taxes, which is, I think, politically untenable at this point. Who knows? Maybe it will be. Joe Biden seems to be thinking they can push through a raise in the corporate tax rate and some modifications, which, those are probably going to be fine. But really what this is referring to is to really put a dent in reducing our government debt. You would really need to raise taxes to the degree that they did back in, probably the World War II timeframe, which was taking marginal rates up from 40% to 80 or something like that. And that's untenable for a variety of reasons, because that would kill the economy. The one main way that governments tend to finance debt is through inflation. They try to what's called inflate away the debt. And this is accomplished through a very important term, which is negative real yields or negative real interest rates. Let me just explain what that is real quick. A real yield is nothing more than taking a stated interest rate like the 10-year bond yield, which is right here, subtracting out a inflation expectation, and there are market gauges of inflation expectations 10 years out. They call it the 10-year break even. That's what this number is here. The market expects 2.15% over the next 10 years. And then you arrive at your real yield, and you might notice that this is a negative number. And so the reason this is important, it's because if inflation is rising faster than nominal yields are actually stated, then what happens is income growth grows faster than inflation, and therefore that allows a larger revenue base for the government to tax at the current levels, which allows them to pay off their debt in an easier way. It's kind of like, it's not too dissimilar to thinking about a mortgage where we all expect to have raises. If you're still working, you expect to have a raise of 3 to 4% or something over every year. If you just lock in a mortgage rate call it a 30-year mortgage rate right now, call it 3%. Well, that 3% mortgage, which doesn't change in principal and interest payments, it's stated for the rest of the life of the note, that gets easier and easier to pay off the further into the mortgage you get, right? Because if your wages are rising at 3%, in 10 years, you'll have essentially a 30% higher income, which allows you to pay off that mortgage much easier. So that's how this gets accomplished. And negative real yields are clearly the focus of central banks right now. And I'm sure the fiscal authorities are happy about it too. It's because it allows for debt to be paid down in a way that people don't necessarily notice. But we certainly as investors should notice it, because the price you pay from everything from housing to gasoline potentially to healthcare costs, college, all are rising, and inflation is the way that happens, if that makes sense. So negative real yields are the goal here, which is why the Fed and others are keeping interest rates low on the front end. So what's happened with real yields? So I just showed you a chart how it was negative 1 points or 65 basis points. That was, I think, at the end of February. And that's what this is showing you right here. But what have real yields done? They've actually gone negative here, starting at about the time that the pandemic began. And this is exactly what the Fed and others are trying to accomplish, because it means that debt service will get easier over time as wages and assets inflate. It just allows the debt burden to get easier over time. But this is an important chart because that's if the Fed and others are targeting negative real yields, well, they're not going to let interest rates rise too high above the inflation rate, because then they would be moving it back into a positive situation, and then debts would get harder to pay off once you move positive. The other item that I know has been important, or I've heard people talking about, is now there's some competition for stocks, in that bond yields are now yielding a similar level to stock yields. And I think this is not necessarily, it's gotten a lot of airplay recently as the bond, dividend yield has reached, the bond 10-year bond yield. But I think this is really just, searching for something that's not really there, because, if you look back just 2 years ago, the bond yield in the 10-year was much higher than the dividend yield. And there really wasn't a huge issue within the markets, particularly earlier in 2018. Now, latter part of 2018, there was a sell-off. But, that I don't buy this argument that, now that we've eclipsed stock yields with the 10-year bond, that this is some like a major inflection point. I just don't buy that. And furthermore, evidence would suggest that now that stock yields, what happens every time, bond yields move up and through stock yields, meaning that they get higher. Well, it looks like if you use the last 4 times that occurred, the market was positive, in every situation, almost every situation, 1 month, 3 months, 6 months later, and not to an insignificant degree either. Certainly there are episodes here and there where that wasn't the case, but every time this prior chart occurs that I just showed on the screen, stocks tend to do well. And I think that's kind of what you're seeing here, is a bit of a positive follow through from that dynamic. Interestingly, as you might expect, bonds don't do well in that situation. And it usually, I think a lot of it just has to do with the momentum in the bond market just continues on as yields migrate higher. So the final piece I did just want to point out, now this is obviously, there's no science to this, but I did want to just extend what you're seeing on the chart here is a look back over the last, call it 12 years or so, 11 years of the 10-year bond note, starting all the way at the lofty levels of, call it 3.8% back in middle of 2009 to where we are today. And it does appear that, somewhere in this neighborhood of 1.5 to, 1.75, 2% is when things start to break free a little bit. Who knows exactly what that level is going to be, because there's plenty of dynamics that could be at play and reasons why, this becomes problematic. But, it does appear that within this neighborhood, it's a pretty significant level for institutional investors. So we should expect, again, a bit of volatility within this neighborhood if we get there. Sorry, just got a dry throat. So that's the end of the remarks. And I guess to net it out on that last question, at what point do bond yields become problematic? There's no exact level to that. I mean, a lot of historical evidence would suggest, it's really when you get into the levels of, 3-4%, that would be accompanied by inflation is really where stock PE multiples start to come down pretty dramatically. And of course, we're well off of those levels. So, we've got a long way to go before we get to that upper threshold. Anytime between, now and 4%, I think it's really going to be about how fast we get to the next level, call it 2%, as opposed to getting there. and I think it's just something to keep in mind, but that's going to create opportunities for us if we're patient. And so I think we've done a lot of work around de-risking our accounts, particularly in the bond side, to account for some of this, dynamic that we see in front of us. And we still think that there are going to be things to do going forward. One question that has come in, and that is a topic that's come up a lot in the press, which is the 60-40 portfolio still valid? So thanks for that question. I've been writing a lot about this with our team, and I do think that a traditional, in the sense that it's traditional 60-40 portfolio where you've got high quality bonds filling out the 40 and stocks filling out the 60, is coming into question, because at some point your rates of return on your bond side get so low that they're just not worth allocating very heavily towards. So as you might be aware, we about 5 years ago we started looking for what could be a bond substitute for us. First, it was some of these liquid alternative strategies that are income generating. And I mentioned a few of those, but like macro strategies or, insurance linked strategies. But both of those have, 3 to 4% plus yields to them. It's just you're taking on different risks to get and achieve that yield. And we think those are good places to start looking. So there is a natural substitution that occurs. Also, looking at private markets, I think, has become much more accessible to us, particularly since we started our private markets platform about 5 years ago. And that's giving us really good access to high quality income generating opportunities. Again, you're taking different risks in private markets than you are with bonds, but it's just important to recognize that. I do want to thank you for joining us today. Please tune in next month. It's going to be first Tuesday of every month. Look forward to talking with you all then. Thank you, everybody. Take care.